Hey, Pay Tax Once Nation. Good morning. Hey, a little longer video today. I want to share with you a couple of case studies, and these case studies are from real clients. And what brought me about this today is I recently had a meeting with an existing client that is retired, and one of her biggest problems that she's expressing is the income taxation on her qualified assets. So you think of IRAs, 401ks, SEP plans, cash balance plans. And interesting enough, she's realizing that along the way, years ago, when she started saving for retirement, and she did a really good job. She's got 7 figures in a retirement plan. It's a qualified plan. So basically, the IRA that she has now came from the 401ks that she was using during her business career. Interesting. She bought into what everybody was telling her, CPAs, accountants, peers, coworkers. You got to save for retirement. You got to put money in your 401k. Reason being, one, you'll save taxes on those contributions going in, and likely you'll retire in a lower tax bracket. Well, fast forward 20 years later, she didn't retire in a lower tax bracket. Matter of fact, the biggest expense she has right now in retirement is federal and state income taxes. And a lot of people ask me, Stephen, how do you avoid paying income taxes, or how do you reduce the income taxes on our money coming out of our qualified plans in retirement? And my answer to them is, it's really difficult to do that unless you do Roth conversions. But if you do Roth conversions at that time, there's a lot of implications that occur. For example, if you're doing a Roth conversion while you are in retirement and you're drawing Social Security benefits, depending on the size of those withdrawals, those distributions, it can trigger income tax on up to 85% of your Social Security benefits. The next kicker is if you reach a certain threshold, now your Medicare, your health insurance premiums are increased. And we looked at some scenarios here a couple of days ago where if we took this much out and converted, or that much out and converted, her Medicare premiums went from roughly $160 to almost $400 a month. Now imagine her being married with a spouse. Well, now his Medicare premiums are because it's a household, they're going to go up the same. So now you've got $800-900 a month for Medicare. That's crazy. And again, to add insult to injury, now her Social Security benefits, up to 85% of them are going to be taxed at the marginal rate. And we looked at a variety of marginal rates based on how sizable the Roth conversion was. So if you're going to do a Roth conversion, and there's some sticky things about that too, I'm not against them, but it's best to do them early on. However, for you folks that believe income taxes are likely to increase and increase a lot during or even prior to your retirement, you want to get your assets, your money away from income taxation, away from capital gains taxes. And by the way, one of the candidates is talking about a 43% tax on capital gains. That's crazy. And then even another tax on gains that aren't even realized. Now, I know that only applies to billionaires from what I'm reading, but why should they stop there? Once they figure out the billionaires don't have enough money, they're going to come after us, because there's a lot more of us than them. But anyway, the conversation was, how do we fix this? Well, there's not really a way to fix it once you're there. But prior to retirement, and for the Pay Tax Once Nation members, subscribers, I get you guys. I figured this out 20 years ago. If I'm putting money into a 401k or an IRA, I'm only postponing my taxes on that money. And I, like many of you, likely won't retire in a lower tax bracket. So if all of our money is tied up in these pre-tax plans, or even a sizable amount in our pre-tax plans, we're going to be forced out. We're going to be forced to spend that money at age 72. And who knows what the income tax rates or the brackets will look like at that point. So many of you, I appreciate your messages. I appreciate your feedback. Wanted me to show you a couple of case studies. So I'm going to do that today. But the key is here, if you're in your 40s, you're in your 50s, you believe income taxes are going to dramatically increase. You're not big believers in qualified retirement plans, especially those of you making mid to high six figures and seven figures. I mean, what's 35 grand a year going to help you? Like, that's going to help you in retirement. You realize that. I mean, your business is your best investment. But all besides that, I'm going to show you a couple of case studies where clients are taking after-tax money and we're putting it into the pay tax once strategy. And by the way, this is a strategy that's been around for over 100 years. Banks in Wall Street have used this. They use that. Matter of fact, if you've seen one of my videos, there's a international bank homed here in the United States. They've got $23 billion. And that's just as of 2019. They have $23 billion in the pay tax once strategy. But yet, when you go to their bank and make a deposit or talk to them, they're not saying, hey, why don't you do this instead? No, they want to take your money, loan it out 10 times and make 1,000% profit. But anyway, that's all water under the bridge. Nothing wrong with that. That's how banks operate. But for you savvy folks out there that are running businesses, you're busting your tail, expanding, growing, and even buying other businesses. The pay tax once strategy is a phenomenal way for you to accumulate wealth, have control of your wealth, have liquidity of your wealth, even way before you retire. I mean, imagine you having control over the financial assets that you possess. And what I mean by you having control is it's off the radar screen of the IRS for income taxation. And this is all in the tax code. This is not a loophole. Loopholes can be closed and eliminated. This is tax law. And it hasn't changed. It hasn't changed, but maybe 3 or 4 times in the last 30, 40 years. And it changed for the good about 2 years ago. 2 years ago, the rules changed to where we can now put more money into these puppies, which is a really good thing because it hadn't been changed in 40, 50 years prior to that. So let's move on to case study number 1. And by the way, if you like what you see here, please subscribe, watch some of the more videos. And if you want to talk about your situation, hey, shoot me an email. Let's get together and have a conversation. This fully be funded $1.1 million, and that's pretty darn accurate. His estimated annual retirement distribution coming out of this plan is $78,000 and change. And it's 100% tax exempt. It's not going to affect his Social Security, and it's not going to affect his healthcare premiums when he reaches 65. If you look at those numbers, it's about a 7.1 distribution rate. And we've all talked about safe withdrawal rates being in the 3.5% to 4%. This is almost double. And the 3.5% to 4% is before tax. So let's look at the comparison between pay tax forever into perpetuity and just paying tax once. So I'm going to use $1 million, 4% safe withdrawal rate. That's going to net my client, gross, roughly $44,130 before tax, right? Again, this is based on safe withdrawal rate. You've probably heard of the Monte Carlo. You've probably heard of the Trenny study, but this is where that number comes from. So if his combined tax rate when he retires is 25%, his net out of that's roughly $33,000. Not a lot compared to almost 78. Are you kidding me? So using gross numbers, let's take a look at this. For 44 to 78,000, that's a 77% increase in cash flow. 77% increase in cash flow. So if you're retired, my question for you, or in your retirement, if you're still working, hey, I get it. A lot of my clients are still working. But when you get to retirement, would 77% more cash flow be pretty good for you, especially if it was tax exempt? Absolutely. Why would you not want that? Okay. So his distribution from the strategy, again, it's not going to trigger income taxes on his wife's Social Security or his Social Security, which could save him up to $250,000 over their retirement lifetime. We've worked numbers and everybody's different, but on average, it's roughly $250,000 to $300,000 in additional income taxes on Social Security benefits over a retirement lifetime. That's crazy. I'd rather have that money in my pocket. So case study number 1 that I want to show you here, we've got we've got a business owner, and before they became clients, he and his wife wanted to change advisors. And again, he is an S corporation. Very unhappy. His current advisor wasn't being very responsive to him, and really failed to provide any useful value to his situation. He was concerned, and his wife was concerned about future tax increases. They didn't want to lock their money up in pre-tax plans. They wanted liquidity, access, and control. Matter of fact, this particular client was able to use almost $500,000 from his strategy during COVID in case he needed it to prop up his business during the lockdowns. And at the end of the day, my clients wanted to pay tax once on their money as they earned it and put it somewhere where it could be safe from taxation and the increases of taxes. Not a big deal. So yeah, one and done. Pay your taxes once, get the IRS off your back. It works. It really works. So additionally, the only advice that he really got from his advisor was to max out his SEP. You'll be fine. You'll retire in a lower tax bracket. I'm like, right, that's not going to happen with this guy. So I said to my client, really, is that all he told you? He goes, yeah. Okay. Well, let's find a solution to the problem that you had. So this strategy has my clients paying taxes once for the rest of his life on his after-tax money. Okay. So fast forward to today. I mean, again, this happened 3, 4, 5 years ago. He set up his pay tax once strategy. He's positioning 6 figures a year of his after-tax dollars, and he's putting it into a strategy. He'll have it fully funded with roughly $1.1 million in the next 10 years. He wants to retire in 12 years. But his plan, and I know you would too. I want to emphasize, during his accumulation phase, he does have access to his money if he wants it or needs it. Again, this particular client did need it during the COVID lockdowns. Again, he took some money out and tucked it away in a money market account just in case. Turns out he didn't need it, but it was there. Look at maybe somebody else that had all their money in a qualified plan. You can't touch that money before 59 and a half without paying taxes and a severe penalty that cannot be offset. That's a big time problem for me. So again, he paid his taxes once, one and done. He's over, he's done, he's happy, his wife's happy, everybody's happy. And like we all know, happy wife, happy life if you're married. So case study number 2, a little different. Numbers are a little bigger. Again, this strategy is scalable. Looking at a client with an S corporation. This particular client, very, very, very well off financial, done a great job. Guy started from zero, went to hero in a matter of, 7, 8 years. But he asked me if there was something he should be doing that is not. And he was angry because he had to pay quarterly taxes on his brokerage account on the realized gains. Because again, sometimes people cash in those realized gains. But he had to pay quarterly taxes on the gains of his brokerage account. He was concerned about giving away huge chunks of his money, huge chunks of his wealth to future taxes. Again, he's one of those guys that he studies, he understands what's going on in our country and feels that taxes are going to have to increase. And I believe him. I come from that same school with $34 trillion in debt. I mean, how are we going to pay for that? He also wanted liquidity, access, and control of his money. Other than owning his business, he likes to dabble in building custom homes and selling them. And he hates dealing with banks. He has to be run through the meat grinder every time he wants a loan. In this case that we did for him, he had close to, he had close to $1 million in his strategy already at that point. He needed $400,000 to finish a project. Well, we got him $400,000 in 7 days. He had his project finished. 3 months later, he had it under contract. Way before that, sold the house, took his profits, and he paid himself back just like that. It was pretty easy. And again, I can't overemphasize, there's no penalty and there's no tax on this. So in a short period of time, again, fast forward, and we did set up and implement his pay tax once strategy. Same kind of strategy used by banks, Wall Street, your peers, major corporations, financial institutions. He is positioning 6 figures of investments, so after-tax investments. He's getting some of that off the table. And 7 figures of money he's got sitting in money market accounts. I mean, the bank's giving him a decent return, but he's getting 1099s on that every year. You don't get 1099s every year in the pay tax once strategy. You don't have to pay quarterly taxes. That's not how it works. So his plan is targeted to be fully funded with $3.8 million in 8 to 10 years. Okay. His estimated annual retirement distribution from his strategy is $263,569, and it's 100% tax exempt. That is mailbox money from the day he retires to the day he croaks. His distribution rate is not 4%. It's almost 7%. When you look at the distribution coming out of his pay tax once strategy, it's 6.9%. That's crazy money. So let's compare this to a pay tax forever strategy. 3.8 million times 4%, $152,000 and change before tax. And again, do we know what taxes are going to be 10 years from now? I don't know. If his combined tax rate in retirement is 25%, his net paycheck will be $114,000. So you're just using gross numbers in comparison. You take a $152 to $263,000. That's a 73% increase of cash flow, and it's all tax exempt. And my question for you is, why wouldn't you want that? Why wouldn't you want that? And guys, this isn't crazy stuff. This is in the tax code. This is one of the simplest, well-hidden strategies on the planet. And you've been told that it's no good. Yeah, and you've been told it's no good by the very people, the financial institutions, the banks, that it's not a good investment and it's not a good place to put your money. Well, then why does one bank, Bank of America, own $23 billion? That's crazy. That's billion. So if you're an S-Corp owner, you can avoid hundreds of thousands of dollars in your future income taxes if you like by using this one simple strategy. Again, I'm going to pound this and pound it hard. It's used by banks, Wall Street, billionaires, and your peers. We're going to later in another video discuss some 3 approaches of creating this wealth and discuss the 3 approaches of creating wealth using traditional planning models. We've exposed some of the problems triggered by traditional planning and how to avoid them. So my next offer to you is, hey, just simply click the button below and subscribe. Watch some of the videos I have, comment, give us some feedback. If there's something that you'd like to see, let me know. I'll be happy to record another video on this. And by all means, if you'd like to talk about your situation confidentially, just shoot me an email. I'll be happy to get together with you. But appreciate your time today. And if you see this before the Labor Day weekend, enjoy your weekend. Have lots of fun out there. And we'll see you soon, guys. Take care. And again, thank you for your time.